Thank you all for joining us for the Raising and Managing Capital in a Challenging Environment panel. Today, we're very lucky to have 4 terrific panelists that will be able to provide perspectives from the BDC operator and the investment banking side. Today, we have Ira Penza, Managing Director of Wells Fargo Securities, Steve Arnold, Chief Financial Officer and Chief Operating Officer of Capitala Finance, John Klein, President and Chief Operating Officer of New Mountain Finance, and Sajal Srivastava, Co-Chief Executive Officer and co-founder of Triple Point and its BDCs. The COVID-19 pandemic has created unprecedented times for BDCs and the capital markets generally. Therefore, this is a great opportunity to get some insight on how BDCs are responding to these uncertain times when raising and managing capital. Today, we're going to break the discussion up into 2 sections. First, we'll start with the current state of capital raising options for BDCs, and then we'll move on to managing the balance sheet and liquidity for BDCs in light of the COVID-19 pandemic. Let's start with the first question, which will be for Ira. Ira, can you please give us a brief update on the BDC capital markets, including the types and terms of capital available to BDCs in light of the current COVID-19 pandemic?
Sure, Vlad. And first I want to say I'm happy to be on this panel with my fellow panelists. I am not happy of not being in DC for this event. I definitely missed the in-person conference and the fun after-hours event, but I'm sure next year will be amazing. Before I touch upon the various capital markets for BDCs, I want to make a quick observation on the space. When the crisis hit and all the capital markets froze, the BDC index was down 60%. You saw in other industries what happened. Some of them had an immediate need for rescue type of financing, think mortgage rates, versus BDCs had a lot better time managing to that initial liquidity crunch. In hindsight, it was very encouraging to see how durable the space is actually. Portfolios held up better than expected. Same with funding structures. Managers stepped up and supported their BDC vehicles. We actually saw lenders act in a manner that didn't put any single BDC out of business, right? And BDCs utilize different tools to address the liquidity, their liquidity position, whether it was asset sales, accessing institutional revolvers, or rights offerings as needed. As far as capital availability at the time early in the crisis, we actually got a lot of calls in April and May timeframe from hedge funds, private equity shops, and family offices who were looking at the investment opportunity in BDCs. They wanted to provide and offer capital solutions to BDCs. Unfortunately, at the time it was pretty expensive, so they were looking for returns of north of 20%. So I don't think any BDC took advantage of this expensive type of capital. As the market strongly rebounded, driven by the aggressive actions from the Fed, we saw resurgence in capital markets activity. Unfortunately, it didn't trickle down to the BDC space as much as it did for other industries. On the equity side, we haven't seen a regular way follow-on offering since January 2020, when Triple Point Venture Growth BDC was the last regular way follow-on offering, so good job, Sajal. And we don't see it today because, again, the space is still trading at 25% discount. The BDC index is trading at 25% discount to NAV. On the debt capital market side, we do see a lot of activity, especially recently. And just let me take a step back. If you remember, at the end of 2019 and early 2020, the market backdrop was very favorable for BDCs. Investor receptivity was really good. Spreads were extremely tight. If you remember, Ares Capital Corp raised $750 million of unsecured notes at 165 basis points spread in January of 2020. I think this was the tightest BDC spread as far as I can remember, actually. The all-in yield for that deal was 3.3%. When the crisis obviously hit, spreads widened extremely. We saw the investment grade index spread widened from 100 basis points to almost 400 basis points. And spreads for BDCs, given that they are high beta names, widened double that. We tracked them and they were in the range of 800 to 1,000 basis points, some ridiculous numbers. So as the Fed continued with their liquidity support for the market, both the investment grade index and the high yield index traded down to normalized levels, while treasury rates remained lower. which created the perfect environment for corporate issues. And again, we saw spreads for BDCs continue to tighten, but not in line with other investment grade names. So in kind of late April, early May timeframe, you saw a few BDCs tapped both the unsecured 144A market and the debt private placement market. And they did deals in the context of 8.5% yield. These were predominantly defensive type of transactions, addressing whether it was a liquidity concern or a leverage concern. As spreads continued to tighten, you saw a few deals done at the end of June and early July in the 6.25 context from a yield standpoint. Until the second week of July, when, again, Ares Capital Corp raised $750 million of unsecured notes in the public bond market at a spread of 370 basis points for an all-in yield of 3.99. So what I would say is BDC new issue spreads are almost probably more than double from the levels we saw early in 2020, but all-in yields are only 50 to 60 basis points wider because treasuries are so low. I mean, think about it. In January, the 5-year treasury was 170. Today is shy of 30 basis points. I'll make just one last point. Key lesson that we learned from this crisis is the benefits of having diversified funding structure, especially with having unsecured debt represent a good portion of your cap stack. I mean, think about it. Unencumbered assets present such a huge flexibility to manage your bank lines and collateral under your other structures. I would envision more emphasis on unsecured debt over the next 2 years. And actually, my expectation is that few BDCs will probably tap the high-grade market in the next couple of months before the election.
Thank you, Ira. And I'll just note two things I should have noted. There is a presentation that Ira provided that is available for the audience with this panel. And to the extent Steve, John, or Sajal, you wish to chime in on anything that Ira is discussing, please feel free.
Yeah, but I'll jump in. I would agree with Ira. I mean, I think the markets have improved. I would say my 2 cents as a manager is, I generally view all the types of capital, equity or debt, are available, but whether or not they're attractive to raise right now is a separate story, right? Equity can be had at the right cost, manager subsidizing, whatever various structures we'll talk about later. Debt pricing has improved, but again, the question is, is it worth the cost or the price associated with it? And if anything, it feels like, the takeaway lesson is it's better to raise, before a crisis than when you're in it, because the pricing obviously reflects crisis terms and risk and things of that nature.
I did have one follow-up to the first question. You touched on debt instruments. I have received calls over the last few months about convertible bonds, and we saw a prospect put up a $1 billion convertible perpetual preferred stock. Wanted to get your thoughts on that, and if you think that's an attractive option that many BDCs might pursue.
It's a very good question, and we also get the same number of calls probably from BDCs trying to figure out if they can issue converts at attractive levels. You're right. The convert market was actually on fire early in the crisis. I mean, there was 60 billion record issuance of converts done in the second quarter of 2020. And usually the convert market is dominated by tech and healthcare companies, but we saw converts being done across various industries, including companies in industries significantly impacted by COVID-19. What I would say again is we didn't see the same resurgence in the convert market for specialty finance names, which includes BDCs. There were a few convert deals done by REITs, but again, they were more distressed type of situations than, real attractively priced converts. I would say there are a few reasons for that. First, BDC stocks were significantly impacted. Obviously, they traded significantly down. Second, there is a limited universe of investors who looked at BDC converts. But more importantly is how they view this instrument. They view it purely as an yield-driven instrument, i.e. they don't attribute any value to the upside in order to buy down the coupon. So theoretically, you should always price a convert coupon at a lower level than you can get in the straight debt market. However, that's not the feedback we're getting from investors. So if anyone is rated today, if any BDC is rated today, they they can access the high-grade market at more attractive terms than the convert market. As far as convertible preferred, you mentioned the prospect deal, obviously. It's pretty unique structure and creative structure, so I would encourage people to take a look at it. But what is interesting about it, what could be interesting for other BDCs, is the fact that the rating agencies are giving this instrument 100% equity credit, right? Otherwise, as far as convertible preferred structures, they're not truly a popular instrument. We haven't really seen them in the public markets. We've seen a few larger transactions in the private markets, but again, very rarely. Although here, I do like the fact that the rating agencies are giving 100% equity credit. So if anyone needs to manage leverage or the dialogue with rating agencies, this could be an instrument for them to look at.
I would just note that for 40 Act purposes, preferred stock is a senior security.
Correct. That's correct.
We'll move on to another question also for you, Ira, and others feel free to chime in. Do you feel like the capital markets have been equally open to all BDCs recently, or are there certain types of BDCs, such as larger or those BDCs that focus on specific asset classes, that have been able to take advantage of opportunities that others haven't?
You're trying to put me on the hot spot. No, just kidding. I would say my answer to this question is high-quality BDCs have better access to capital, period. So if your portfolio is solid, if your portfolio is diversified, if it's skewed towards senior secured loans, if you have minimal exposures to the industries that are significantly impacted by COVID-19, and if you had good, decent track record and performance over time, over the last couple of years, you absolutely have more access to capital than others. I would also say BDCs affiliated with larger asset management platforms or insurance companies are also more likely to attract capital in today's environment. Remember, there are certain investors who are still on the sidelines given caution around BDCs portfolios and expectations for elevated losses. So that's why people are looking for, more solid and senior secured portfolios than something that's a little more hairy and kind of risky. I would also say investors like liquidity. They place even more premium today on liquid deals. So larger liquid transactions are easier to place than smaller ones, which again benefits a little bit more the larger BDCs than the smaller BDCs. We do, as far as you pointed to size, as far as size, we definitely see how scale differential is growing more and more in the traditional middle market. Now, if that's going to lead to difference in performance over time, maybe, we'll see. But what I have to tell you is that the smaller end of the middle market will probably underperform, given that smaller companies were impacted more significantly than larger companies in this crisis. And again, a lot of BDCs took, a lot of BDC's portfolio companies took, Paycheck Protection money and CARES Act money, but I'm not sure in how many cases those were just Band-Aids versus solving the liquidity issues completely for the specific company.
Thank you.
And to your point, specialty finance BDCs such as venture lenders actually performed better during this crisis than your traditional middle market lending BDC. I feel like I'm giving too much props to Saljo, but I guess.
Yeah. We'll ask some other questions that may let others speak. My next question has to do with various defensive capital raising actions that have either taken place or a lot of folks have sought below NAV approval. There were a couple of rights offerings in the past few months. I'll start with you, Ira, but others feel free to jump in. What are your thoughts? How does the market react to some of these transactions that may be dilutive to shareholders temporarily?
Sure. I have to tell you, early in the crisis, this type of defensive offerings were probably the right thing to do for certain BDCs. I mean, there was so much uncertainty, and we talked to a bunch of BDC managers, and they looked at different scenarios trying to figure out, the downside, and nobody could really predict it. So I think certain BDC managers, as they looked at, how things could evolve over the next couple of months, they decided to be more proactive and raise this defensive type of capital, shore up their balance sheet and their liquidity positions. Are investors unhappy? Of course, when there are dilutive equity offerings, investors are not happy. But, and we led one of those rights offerings when we went on the road with investors, the virtual road show, and the manager explained the rationale, the thinking behind it. I think investors got comfortable with it. Again, remember, at the end of March and early April, it felt like the world was falling apart. So I think that for certain BDCs, given their specific circumstances and challenges they were facing, this was exactly the right thing to do. And nobody took this action lightly. Nobody said, oh, let me do dilutive rights offering because I can. They went through a very rigorous and thoughtful process, answering a ton of questions to figure out what kind of capital to raise. Is now the right time? Advantages of this capital in an upside and downside scenario. What am I willing to give away? At what cost? Does this solve all of my liquidity issues, et cetera, in order to come to this informed decision of, hey, should I pull the trigger today or not? And it made sense for certain BDCs.
Do you think we'll see actually below NAV offerings in reliance on the approvals that people have been seeking?
So it's actually, you're bringing a good point. We always struggled, especially in the bull market over the last 10 years, how to think about, BDCs asking every single year shareholders approval to be able to issue stock below NAV. It's a good thing. On the heels of this crisis, it's actually a good thing to have as a tool, right? Because you will need this approval exactly in a scenario like what happened during this crisis. And some BDCs who wanted to, let's say, access this market and raise, let's say, equity below NAV with institutional investors couldn't do it because they didn't have the approval. Just as a reminder for the audience, for a rights offering, you don't need a shareholder approval to do a rights offering. I think you will see more of those just as a tool. BDC would like to have that tool going forward. So I think that a lot of BDCs will add this as part of their shareholder meeting, getting an approval to issue stock below NAV. But I don't think you will see regular way equity offerings below NAV. You're more likely to see rights offerings or PIPE transactions with, a single or a club of institutional investors than your true retail offering that's below NAV. That's not going to happen.
Thank you.
Vlad, if I go ahead.
Please.
Oh, I was going to just jump in and say, from my perspective, I think raising capital is a real special privilege that all of us BDC managers have, and so I think knowing when to raise, how much to raise, what type is part of what differentiates us too. So it's not only investment strategy and track record and returns and dividend coverage, but I also think capital raising strategy, capital raising performance to that strategy, and then how we've used that capital. So I think, again, from a manager's perspective, every time we raise capital, debt or equity, we have to justify it. We have to make sure it's consistent with what we articulated to our stakeholders, and that's how we feel good about it. And it's easy for, Monday morning quarterbacks to come and back and say, well, why did you do this? And so that's, as long as we're being consistent with the strategy and the messaging, then we feel great and smart about it. I mean, we had critics of our equity raise in January, but then in March, everyone thought we were geniuses. And so I think, again, as a manager, you've got to stick to your strategy, stick to your approach, be consistent. And, we're in it for the long term. But again, we're balancing, managing everyone's expectations plus growing our franchises and stabilizing our franchises.
And if I may add, to your point, in hindsight, it's easy to judge, right? Who was genius, who pulled the trigger too early or not. But you made a point how you have to be consistent. I'll kind of come back to this. Well, no one on the road to COVID-19 scenario. So I can't blame if somebody has consistently said that they will be always shareholder friendly and never issue stock below NAV, because this was a different crisis. This was a healthcare pandemic. This was a crisis that no one has lived through. So I think that people had to put different thinking cap to figure out what is the best action for their BDC in order to protect their existing portfolio and move forward.
I think one thing that COVID-19 has taught us, though, is that we have to use all the tools, in our tool chest to basically, build up our companies such that we won't need to if faced with another pandemic or another tough situation, we won't need to issue equity below book. And so I think it's really, and at least at our firm, it has caused us to look in the mirror and think about all the things we can do to make sure our balance sheet's as strong as possible in all times. And I think, every manager can look themselves in the eye and say that going into COVID, there are things that we all could have done better. I think the key is to learn from that, because I really don't think it would be good for the BDC industry as a whole to really consider below NAV offerings as a tool that you use unless it's an absolutely dire situation and you have to use it. But there are a lot of other tools that I think are in better long-term interest of shareholders.
Well, I might offer as well. This is Steve. We've asked our shareholders for below NAV approval over the past few years, and have been blessed to get that. But we've never issued shares. We really view this as situational, and from our perspective, it's nice to have that option. And as Ira said, right, it's having those tools in your arsenal are good to have, but you've got to be good stewards of that. And I think it's just something we continue to wrestle with as an industry.
That actually leads to my next question in terms of communication with stockholders and other stakeholders. During the pandemic, you saw many managers put out stakeholder letters. John, Steve, Sajal, if you could just briefly touch on how your firms have been communicating with shareholders and stakeholders during the pandemic.
Great. Since you said my name first, I'll just jump in and go first. Our mindset at New Mountain is to be as transparent as humanly possible. And I think the letters were, a great way in a tough period of time to be very transparent. One thing that COVID taught me, or one of many things it taught me, was that when things get really rocky, investors really have a lot of imprecise metrics they can look at to evaluate BDCs, and they look at leverage, they look at liquidity, and they can look at a few other things, but they really can't have deep insights into the portfolio because there's just so many positions in every BDC, and they're all private names, and so it's really tough. And so anything we can do as a company, as an industry, I think, to provide a better insight in the portfolio to reduce the blackness of that box, if you will, is pretty important. So we're big fans. Ironically, we were a little bit late to the game in issuing our letter because we were, talking internally about everything we could do as a manager to defend the company in the instance that things got even worse than they got in late March. So we were a little bit a little late just because of some compliance issues, but very pleased when we were able to issue that letter. And I think our letter, along with I think most letters, were very well received. And on a go forward basis, we've just pledged to our investors to try to do the best we can to be as transparent as possible, within the confines of the law. And I think the best way we can do that is just deliver letters if necessary, but just, on a quarterly basis, just great information that gives deep insight into our portfolio for our investors during our quarterly calls. Additionally, we've been pretty aggressive, and I think this has worked well for us about, obviously being in weekly contact with our, revolving credit facility lenders, and then also holding private calls with our note holders, with our private level note holders, to really make sure that they're comfortable with what we're doing, especially in a COVID environment.
Thank you, John. Steve or Sajal, anything to add there?
I'll add. So we did not issue a shareholder letter, and there were a couple of reasons why we didn't. Is we raised equity in January. March 19th, we did a private 4A2 debt offering, so we sort of felt that from a liquidity perspective, we had both sides kind of addressed and low leverage kind of going into the heart of all things COVID, but also from our playbook. I think from John's point, so for us, priority first was our employees, sort of dealing with working remotely, making sure everyone was safe, settled in, and healthy, kind of playbook point number two was, okay, our existing portfolio companies kind of going out there, checking in, triaging them, as we all called it. Our sponsors were next. We reached out to all of our VC sponsors, kind of getting the lay of the land for them. And then we said, listen, the next kind of critical constituent for us are revolving bank line providers, right? They critical source of capital for us during these, although we had plenty of cash from equity and our debt offering, but making sure our banks were, again, banks tend to not be the most rational folks, no disrespect to banks, but during periods of crisis. And so we felt over communicating with our warehouse providers, being extremely proactive was particularly important. And so as we sort of made it through, we're like, wow, okay, we're week 5 into the end of the quarter. We're level 3, all of our assets are level 3 anyhow. And so it's not like we knew where values were until, we did a significant amount of work in the quarterly process. And so we said, wow, we're a week away. The lawyers don't want us to put in all the statistics and numbers, plus it's better to tell with the story. And so we waited for our earnings call. Well, that was right or wrong. That was just kind of our playbook, the way it worked out. And so it didn't mean that we didn't take the calls from, top 10, top 20 shareholders or proactively reach out with them. We did talk to research analysts, plus, large debt holders. But again, it was sort of balancing, where in the process were you from kind of managing your firm, your portfolio, and your market?
Yeah, this is Steve. We try to provide quarterly updates to our shareholders, as part of our normal reporting process, talking about the portfolio, the health of our team, the work from home dynamics, and all those types of things. Early this summer, we did issue a rather detailed release talking about all the liquidity that we were able to generate during the summer months, and how we were going to use that liquidity to do a few things, primarily to reduce leverage at the corporate level through the retirement early of some SBA debentures and through the retirement of some retail notes through a bond repurchase program that the board approved. In addition, supporting the existing portfolio and just provide general working capital for our firm. So I think that was a good message to be able to send out, that we had ample liquidity to delever our company and to help our portfolio and just kind of run our firm. And the last point, I'll echo what was just said, that we continue to receive, a certain amount of inbound correspondence from our shareholders and constituents, and we think it's important to reply to all those. So we're very diligent about returning phone calls and emails and discussing whether they're shareholders, prospects, analysts, or whoever it may be, having those conversations on a timely basis.
Thank you, Steve. We'll switch gears slightly and talk a little bit about private BDCs now. We'll go to Sajal. They've become very popular over the last 5 years or so now, and I note that you raised a private BDC during the pandemic. Could you take a moment and explain to us what a private BDC is, why they're so popular?
Yeah, sure, Vlad. There was a commercial from the 1980s for the Reese's Peanut Butter Cup, which we all know is this magical combination of peanut butter and chocolate. And it had a great tagline. It said, 2 great tastes that taste great together. And I think that's a perfect way to describe a private BDC, with a private GPLP fund and a public BDC coming together, and the end result is the private BDC buttercup, so to speak. But more seriously, again, the private BDC has a number of the strengths of both a public BDC and a private GPLP fund. From a public BDC perspective, they share the transparency and the reporting overlap, right? The 10Qs and the 10Ks and the requirements to do that. I think one of the key strengths of the private BDC and the appeal, particularly for investors, is not only the regulatory oversight, the SEC, and being subject to co-investment and compliance, but probably more importantly, the tax efficiency for investors, particularly offshore investors, where, again, your BDCs or private BDCs don't need blockers for ECI and UBTI. There's no withholding withholding taxes on the majority of the dividends that we distribute. So I think very investor friendly, and more importantly, low legal overhead to achieve that. With private GPLP funds, you've got to do master feeder structures. So structurally much more efficient for offshore investors, and in general, and John will get to it, ERISA investors as well. I think from a manager's perspective, the fee structures are particularly attractive. So the big, while there are some concessions that the managers make during the periods that you're private, and I'll get to this private versus public period, you are earning your fees quarterly, which is something unusual. In particular, your incentive fees quarterly. So I think that's a big, benefit of the public BDC structure with a private BDC. And then you do have an independent holder, so you have less control as a result as a manager than under a GPLP structure. But again, the benefits from the BDC aspect far outweigh that. And then you get to control your shareholder outreach. So there's no requirement for earnings calls and scripts and fun things like that. You really can decide the frequency and the nature of your communication with your stakeholders. Now, from a private GPLP fund perspective, I think a big selling point is the capital raising process itself, where it's a private placement process. It's not a continuous offering. That's the difference between the non-traded and the private BDCs. Plus, it's a more efficient process. You typically work with a banker. And then another key element is you don't draw on all the capital once. You do raise all the capital, but they're structured as capital commitments. So similar to a GPLP fund, you get to call on the capital as you need it. So it allows you to really be efficient. It allows you to optimize to IRR. Similar to a private fund, there is a fixed life of the private BDC, so it's again a shares that aspect of it, and it's a much more efficient and quicker process with the SEC for the filings, for the review process. So again, a hybrid between the public BDC and the private GPLP fund. But the peanut butter cup, the great outcome, the sum of the parts being greater is what we call the liquidity option. And so private BDCs, again, they're fixed life generally, and at the end of their investment periods, generally, they have three options. They can either act like a traditional GPLP fund and return all the capital, or start returning capital back to their investors. They can take themselves public. They can list on a public exchange, or if you're a manager of an existing public BDC, you can merge your private BDC with your public BDC. So the appeal there is you're able to take this fixed life vehicle and turn it into a permanent capital vehicle from the manager's perspective, and give if you manage an existing public BDC, give it scale. From the investor's perspective, I'd add the benefit there is you're able to take in a liquid asset at the end of your investment period and essentially make it liquid fairly quickly, and theoretically do it at a premium if you're going to list it or merge it with a public BDC. So I think those are kind of the key kind of elements of private BDCs. And the last point is, why did we do it? Again, we're an experienced manager. We manage private capital and public capital. So we have a public BDC. And so we said to ourselves, we had interest from investors, an anchor investor essentially wanted to cross over from our public BDC to our private BDC. They basically said they needed more triple point, and it allowed us to incubate a new strategy that we think will broaden the market opportunity for our public BDC if and when we do merge it at the end of its investment period.
Thank you, Sajal. A question for John. I know you have a public BDC and two private BDCs. One of your private BDCs is 100% ERISA assets. Historically, taking more than 25% of ERISA money has presented challenges for some BDC operators, as that imposed additional fiduciary duties as plan asset managers. What kinds of obstacles, either investing or operational, have you faced in managing an ERISA-compliant BDC, and how have you been able to navigate them?
Sure, and before I answer the question, I just want to emphasize, we do have two private BDCs, and the main reason that we try to get our investors to agree to invest in private BDCs is a point that Sajal mentioned, which is just from a tax leakage perspective. and just really, I think an ease of operations perspective when compared to a traditional GPLP structure. The BDC is just a great a great wrapper for credit assets. And it's been amazing to me how hard it is to convince a lot of our institutional investors that that is indeed the case. And maybe Sejal can teach me something about that. But we've been successful with some, but I've just been amazed how tough it is. I would say on the ERISA question, ERISA presents a lot of challenges. We spent a long time talking to ERISA lawyers. It's a very obscure corner of the legal field, as I've learned, and there are a lot of points that the ERISA lawyers bring up to sort of make you scratch your head and wonder why things were designed the way that they are. But you sort of have to just go with the flow on ERISA and just try to mold the investment strategy and the fund formation to fit ERISA. And I think you mentioned, probably one of the biggest, hurdles for a lot of managers, which is the fiduciary duty section does look a lot different than a typical BDC or a typical fund. You do have a fiduciary duty to ERISA, and I think that does increase my exposure as a manager and our board's exposure, and so that's something we were definitely mindful of at a firm level. At the end of the day, we were comfortable with it, and I think it's just important that you enter into an agreement with the ERISA plan where you're doing things that you're good at doing, and they know that you're good at doing, and and you have to stay very consistent with what you're best at, and not really stray from the core strategy. I think it's even more important when you have that fiduciary duty. The fees the way the fees are charged presents some obstacles or just things to think about. ERISA funds have to pay on committed capital, not on invested equity or invested capital, the way we like to charge our investors. So when they have to pay on committed capital and your ramp period is a 3-year ramp period on a large amount of money, you have to sort of figure out how to deal with that, because if it's a large ERISA plan, they're probably not going to want to pay 2 and 20 on committed only. They'll ramp very, very slowly. So you have to just be mindful. And the way we handled that was just had a pre-baked schedule of fees based on our anticipated ramp. So that could be better or worse for us, but that was the way we chose to deal with the base fee complexity. There can be also complications around incentive fees. On our BDC, we just decided to stay with the base fee. It happens that this is an unlevered account with with a mix of syndicated and middle market loans, so it's a little bit more of a vanilla strategy. So in our particular private ERISA one client vehicle, we just charge a base fee. If you do need to charge a management fee, there are some complications around times when the manager controls the exit of an asset. If you control the exit and sell an asset, you as a manager for ERISA money, you have a lot of trouble taking incentive fees on exits that the manager effectuates. So I could see that being a real problem for a venture lender that could have some big gains. And I think the idea behind that is in ERISA is that they don't want their manager selling all their good stuff, collecting fees, and then leaving the bad stuff behind. Now, in my head, that's what a hurdle is for. But again, you have to shrug your shoulders and say, ERISA does not want to pay management fees on proactive exits, and you have to just live with that. No cross trades, no capital structure conflicts where another fund at New Mountain would be in the second lien and the ERISA funds in the first. We don't have issues with that because we don't tend to do those things anyway. And then the client has the ERISA client needs to have a pretty free and clear ability to fire the manager at their discretion. And as I understand it, that's not all that different than a BDC. Although I guess there are complexities around the board firing the manager, but we view that as an easy give, because if we were doing a non-ERISA separate account, I think any big client would want the ability to fire the manager. So those are some things off the top of my head, and then there are a lot of nitty-gritty details which can be managed through pretty easily.
Thank you, John. We'll switch gears again slightly and go over to Steve. Steve, I know that you recently received a green light letter for additional SBIC licenses. What has it been like getting an additional SBIC license during this period? And has the SBA generally been easier or more difficult to work with to get a license given their role in the various other COVID-19 relief programs?
Yeah, happy to give a few comments on that as the process is still ongoing. As you noted, earlier this year, we received 2 green lights from the SBA for SBIC licenses. One would be inside the Capitale Finance Corp, and the other would be outside the BDC as part of our growth fund strategy. We've been active participants in the SBIC program for over 20 years, and think we have a pretty good working relationship with not only the staff, but some of the leadership over there. As you noted, the SBA did play a key role in the COVID-19 relief, with the PPP program that we'll talk more about, I think, later, but was helpful to our investment portfolio. All that being said, I'd have to say that working with the SBA during this current process has been great. They've been very engaged with us as we provide updates to them, not only about our firm, but about the portfolio that's in our current SBIC program, and just other matters that are integral as part of this very, very structured process to start the process to get all the way through licensing. So it has not been more difficult. I would say it's probably been better. The communication lines are very clear. We're huge fans of this program and the impact that it has on small businesses, and look forward to being, continued participants for many years to come.
Thank you, Steve. With that, we'll move on to the managing the balance sheet and liquidity section of our panel. And we are running a little bit low on time, so I'll combine a few of the questions that we had prepared. So this will be for John, Steve, and Sajal. Can you talk a little bit about how you've been dealing with troubled assets during the pandemic, working with borrowers and sponsors, analyzing credit risk for new potential investments? Has that changed at all? How you look at various potential new opportunities, as well as working with your lenders to renegotiate, extend, or enter into new credit facilities. Steve, since you were just talking, why don't we stay with you?
Sure. So a lot to unpack there. I'll try to be brief on all those fronts. Look, all of our portfolio companies have been impacted in one way or another. Some slightly, and some significantly, right? And it's been the PPP program. Has been very helpful for those that were approved. But ultimately, our portfolio group has been engaged on a very frequent basis with the companies and the management teams, and where appropriate, the sponsors, to help manage through the pandemic. And we'll call that corporate citizenship, if you will. But ultimately, there's got to be some long-term issues related to that have to be addressed. For us, those long-term issues are really minimal, and that's really a testament to our portfolio management team kind of working through these situations on a weekly basis. The key to all this is really having open, honest dialogue with all the constituents that are in play here, with the goal of trying to help these portfolio companies survive and prosper. And if that happens, then everybody wins. On the underwriting side, not a lot's changed for us as we evaluate new investment opportunities. With our first liens focus now, we've got fairly tight loan documents. We model out certain scenarios with these companies and see how they might do in certain outcomes. That's not a new approach. It's really just a heightened awareness of some of that. We've all operated through cycles in our careers, but none of us have operated through something like this. So it's these the times when we have to focus on good leadership and management and communication to make sure we make good investment decisions. That's really what we're focused on. And lastly, you mentioned lines of credit. From our perspective, it's an interesting case. We terminated our line of credit with our group back in the second quarter. It was a mutual decision that we made. really because the line was undrawn and wasn't being utilized much. The bank partners that were in that previous line were great partners, and no ill will there. We are in the middle of putting in place a newer, smaller line, and it'd probably be inappropriate for me to comment about any specifics about that. But we're gonna put that back in place and hopefully have that announced before the end of the third quarter. But the key to all that, again, is with portfolio matters is being transparent with your lenders and just keeping that dialogue open.
Thank you, Steve. John or Sajal, anything to add?
I'll just be really brief. When we think about underwriting, we don't think anything's changed in the way we underwrite. When we think about our portfolio, given the industries that we tend to focus on, a lot of our portfolio was fairly unimpacted in the range of impact. There are certain sectors like retail medicine that saw impact, and we'll probably still do deals in that space, but we'll just need more margin for error in certain good industries that have potential risk around COVID. With regard to covenants, it's funny. I think the best companies will always have covenants that are a little bit more sponsor friendly, and our strategy just happens to be to try to participate and underwrite the best businesses in the middle market economy. So we always feel like there'll always be some challenges that we're going to face on negotiating the best covenants, but we'll trade the best covenants for the best businesses. That's our mindset. And then on the credit facilities, I would say that the banks are currently in a state of pullback that is greater than the risk assets that we're buying. So I do think that within the BDC space, there is some pain where, to the extent you have to renegotiate anything with our banks, or we need extensions or new facilities, I do think the pricing and the terms of those facilities is a little bit more onerous than the changes that we've seen in our asset market, where the pricing and the return for the best assets that we see out there is only a little bit wider than pre-COVID, not a lot. So that's a little bit of a pain point, I think, for the industry.
Vlad, I'll just add on I think great comments from John and Steve. On the credit side, bank side, we've closed the renewal, closed a new facility, received a term sheet for a third facility, begun the renewal process. So we've had the benefit of a really strong, supportive lending relationships with our banks. Now, we've had one or two banks fall and not be able to perform because of COVID, but I'd say we benefited from the fact that we're a differentiated asset class. Our platform, we're part of a larger platform, and then we've had a 15-year relationship with our lead and primary lender, Deutsche Bank, who's been a fantastic partner to our firm across all of our vehicles. And so I think it's the benefit of the prior years, the track record, the consistency, and John's point, obviously we're reflecting today's market in terms of conditions. It's definitely not 90% advance rates and L plus 100, but reflecting current realities. But I think, again, there is credit. There are banks that are active. It's just the key is it's hard to start a new banking relationship with someone that you haven't had one for a period of time and performed during more challenging times.
Thank you. With that, we'll skip to my last question and kind of combine it with another question that I had. I'd like each of you to think into the future a little bit and give one or two predictions for the BDC space over the next 12 to 18 months. And in particular, I'm curious to hear whether you're seeing attractive investment opportunities, or you think there might be attractive strategic transactions, without disclosing anything that you may be thinking about, that might come into play over the next 12 to 18 months. I'll start with Ira.
Sure. As far as prediction, I would say, given the solid performance of this asset class during this crisis of private debt in general, I would expect to see a lot more institutional capital coming into the asset class. I do expect to see more private BDC raised through the high net worth channel. Again, everybody's looking for yield, so you'll see more of those. And lastly, I would say I think that people will be looking more hardly at the BDC wrapper and thinking, are there any other strategies that could take advantage of the BDC wrapper? We have had conversations with folks who do infrastructure assets. Can we put them in a BDC? Healthcare assets, et cetera. So I do think that, and especially given how venture lenders, specialized BDCs performed during this crisis, I think you might see another wave of more specialized new BDCs in the future.
Great. It's good for my business. Steve, Sajal, John?
Yeah, I'll go. I think the next 12 to 18 months really could be transformational. I mean, as we come out of this pandemic, I think the investment activity that we're going to have an opportunity to evaluate for those of us that have ample liquidity should be lower level deals with pretty good pricing to support our distributions. I also think we should benefit some from some of the work that Brett and his team have been doing over at the SBIA as we see, some relief with AFFE and tax reform and the previously passed Modernization Act. I think those are going to be good tailwinds to help us, move along here. But certainly on our end, we're very attuned to kind of the opportunity that's in front of us, but we just got to stay vigilant.
Yeah, I mean, I'll add, we're keeping our heads down. I mean, I think we're still in the middle of this COVID crisis, and so we don't know how long it's going to be or last or second wave, third wave, whatever it may be. So I think we're seeing strong signs and positive signs of recovery in our market, which could lead to, again, periods of growth. But I think we want to be balanced, and, we don't think it's, the appropriate time right now to come in guns a-blazing, but we continue to be opportunistic and selective, and we want to see that we're kind of in the recovery phase before we really, for our public BDC, turn things up from a meaningful origination perspective. Longer term for the asset class, I'm going to take a contrarian perspective from ERA. I mean, I think, and I'm not saying 12 to 18 months, but I'm saying 2-3+ years. Listen, I think managing a public BDC is hard work. It's not easy, regardless of the logo that you've got next to it. I mean, you can trade, even though you may have a premier franchise, your BDCs may not trade that way. And so particularly for some of the fee structures that some folks have, I think some folks will say, you know what? This was a good project. We tried it. Not saying us, but I'm just saying that some folks may realize it's just not sustainable, particularly with the glut of private BDCs that will have to come public or merge. And again, a lot of these fee structures are just uneconomical. And so I just think it'll be interesting 3-4 years when a number of these vehicles sort of a day of reckoning will happen. And the question is, do they all go public? Do they all merge? Or do larger institutions, eat them up, or do they just run off? So either way, ERA, you're going to be busy. You too, Vlad.
Thank you. And we'll go to John to give us any final thoughts from him.
Sure. I'll try to be, maybe a little more controversial. I'll say, in 12 to 18 months, I think there'll be a vaccine, and I think the world will normalize and everything will be okay. I do feel like between now and then, there will be some pretty shocking and substantial losses within BDCs that will be painful. I think that the economy is changing fast. I think there's a lot of secular change out there that's going to cause problems for portfolio companies. And I do think that before the crisis is over, if companies do not have enough capital and do not have enough support, I think investors in those companies could be called out at the wrong moment and could take some losses. So I guess I'm saying, near term, I'm predicting, some tougher times potentially on an asset by asset basis, and over the longer term, I'm still bullish. Everything will be all right.
Great. Well, with that concludes our panel. Thank you all very much for joining today, and stay safe.
Thank you, Vlad.
Thanks, Vlad.